Joining us right now to talk about the markets and maybe a little bit about what this Fed is telling us or not telling us. Maybe Duff, Managing Director and Advisor at GenTrust's. Good morning to you. You probably heard our debate at the top of the hour. I think everybody's still reading these tea leaves. It seemed so clear last week. We sort of heard the Fed. We heard Jay Powell say what he said. We all were sort of shocked at how clear it seemed. And now everybody's running around with their hands up in the air going, oh my God, actually, maybe that's not what he said. What did he say?
Well, I think there was a material shift in the tone at this Fed meeting. If there's anything confusing looking back, it was early December when Chair Powell pushed back on some of the rate expectations. At the actual Fed meeting, I think I heard him say about 10 times that we're very likely at or near the peak in rates, and that looking forward, they would be talking about when the next ease or when they would transition to an easing. I do think the market's gotten ahead of itself with close to 150 basis points of easing priced in the next year or by the end of next December. That seems pretty punchy, and we think somewhat unlikely in the absence of a recession. So that will have to.
What does Mimi think? What is your prognosis though in terms of what the Fed actually is going to do in the next year, given the Austin Goolsbys and the Bostics and you name everybody who's come out and said something about this, which is what I think is, I want to say, confused the issue again.
Yeah, I think that, look, the March date is nearly fully priced for an ease. I don't think that. I think we are going to be looking at some eases in the second half of the year. If we were to move into a recession situation, then certainly we could see that. Since 1974, the Fed has only eased with inflation, core inflation above 2.5% when the unemployment rate is above 5%. We're at 3.7% U rate right now. So we think there's probably one, too much priced in, and two, too early priced in.
In the good news is bad news is good news category, though, there's another sort of element to this, which is, I think, even in the last 48 hours, a new view in the market that maybe actually things are not going to be so great. And maybe that's what's weighing on stuff.
Well, if the market, there's a bit of a disconnect here. If we are pricing in greater odds of recession, then the equity market didn't get that message, I think. So there is a bit of a disconnect. I would say in the past 2 weeks since the Fed, that the surprising thing on the equity side, which is good for our portfolios, we've seen a lot more breadth in the equity rally. And we had tilts towards sectors that would have performed better in a rate stability environment. But I wouldn't make too much of one day, which is yesterday, by the way. December seasonals are very strong in equity markets, and we've seen that play out. And I think that we're just going to have to watch the data. We've got Friday.
Does that mean you're lightening up as you get closer to Christmas? Is that ride the rally and lighten up because January gets tough?
We haven't lightened up yet. Like I said, we're underweight on the equity side, but we're tilted toward these rate stability sort of sectors, and we've actually outperformed the S&P in this latest run up. So we haven't lightened up yet, but it's something that we're looking at. We've moved pretty fast, quickly.
So in terms of just turnover in the portfolio and rotating, which way do you rotate?
Well, in terms of, we've been positioned the same way for the last couple of months. Overweight bonds, underweight some of the real assets, and slightly underweight equities. And for now, we're holding that. We would rebalance if we were to see further, this equity run up. I think we're up 14 or 15% from the high. That's pretty significant move. So we're looking at rebalancing more than anything. We like the state of our portfolios here.